Good afternoon. My name is Lori Goodman. I'm the director of the Housing Finance Policy Center at the Urban Institute, and I'd like to welcome everyone to today's webinar on financial inclusion, lessons learned, and what's next for innovations in alternative credit data. I'd like to thank everyone for attending today on behalf of both the Urban Institute and the Housing Finance Policy Center. The Housing Finance Policy Center's mission is to provide policymakers with data-driven analysis of housing finance policy issues that they can depend on for relevance, accuracy, and independence. I'd like to thank FICO for their support in helping make this event possible. We're fortunate to have just a fabulous keynote speaker, Grovetta Gardenier, the Senior Deputy Comptroller for Bank Supervision and Policy at the Office of the Comptroller of the Currency, as well as a superb group of panelists to delve into a deeper conversation on this important and timely topic. But first, before I introduce Grovetta, let me cover a few housekeeping items. First, the event was being recorded and the recording will be posted online afterwards. The speaker biographies are available online at urban.org. And also they will be in the chat function. So I'm not going to read them in their entirety. All participants are muted. Type your questions or comments into the Q&A box at any time. Lastly, engage with us online using the hashtag #live@urban. So with that, let me introduce Grovetta Gardenier, the Senior Deputy Comptroller for Bank Supervision Policy at the Office of the Comptroller of the Currency. Thank you so much, Grovetta, for being with us today. Grovetta is going to give some prepared remarks and there'll be time for Q&A afterwards. So thanks again for being with us today.
Oh, Lori, thank you so much. I really appreciate the kind introduction, and I'm really pleased to join you today to discuss important steps the Office of the Comptroller of the Currency has taken to expand financial inclusion for those who have for too long been left out of the nation's wealth-building economy. I'll also discuss how consumer permissioned alternative data may be used under today's banking rules to further expand credit access for millions of consumers, as well as the challenges and opportunities in doing so. So first, a little background. The OCC was founded 158 years ago this week. Our mission is to ensure that national banks and federal savings associations operate in a safe and sound manner, provide fair access to financial services, treat customers fairly, and comply with applicable laws and regulations. Our mission is more important today than ever, given the many challenges our nation faces. We can't have a safe and sound financial system if we don't treat everyone fairly, no matter their income, color, or community. Yet 22% of US households, or 55 million adults, are unbanked or underbanked. In addition, the pandemic, like other financial crises in recent history, has disproportionately harmed minorities, compounding wealth and income inequality. Last summer's protests focused much needed attention on these and other inequities that minorities face. President Biden, in one of his first actions, called on the federal government to pursue a comprehensive approach to advancing equity for all, including people of color and others historically underserved, marginalized, and adversely affected by persistent poverty and inequality. For me, fairness is not a soundbite. It's a rallying cry and a responsibility that I was called to work toward. I grew up in rural North Carolina many years ago. And as a child in the 60s and 70s, I don't think I actually recognized until later in life that my parents were examples of African-American leadership. My mother was the principal of my high school, and my father was a Presbyterian minister. Both of my parents were champions for civil rights, as my mother taught and later became principal of the first integrated school in my county. And my father marched tirelessly for civil rights as part of the Southern Christian Leadership Conference. The March for Civil Rights and Equity for All Races still continues, building on progress made in recent decades by our nation and national banking system. By becoming a lawyer, I achieved my dream and hoped that the practice of law would provide a path to address persistent racial and economic injustices. My career in bank supervision has allowed me to fight inequality in a financial system fundamental to the livelihoods of all in America. I'm proud that my work at the OCC allows me to continue this fight by seeking to ensure that our mission of ensuring safety and soundness and fair access and fair treatment is reflected in OCC's supervisory approaches and in the 1,100 banks we supervise. Importantly, the OCC has taken steps to encourage the expansion of financial access for economically disadvantaged and marginalized communities and consumers. For example, to help expand credit to disadvantaged consumers, in March of 2020, we joined other agencies in urging banks to offer small dollar loans to consumers affected by COVID-19. The interagency statement followed the OCC's own 2018 guidance that encouraged banks to make small dollar loans to unbanked consumers who too often pay very high fees to payday lenders and check cashers. While we've made progress through these OCC actions, clearly there is much more that needs to be done. Last summer, in the wake of the nationwide protests, OCC executives asked what more we can and should do to bring greater equity, fairness, and access to marginalized minorities and others left behind and left out of our financial system and economy. The OCC's answer was Project REACH, which was launched last July and stands for Roundtable for Economic Access and Change. The OCC founded Project REACH to bring together the leaders of banks, civil rights and community organizations, as well as technology innovators and other businesses to exchange ideas and identify solutions that help to promote full, fair, and equal participation in our financial system. The OCC is serving as the convener of community-focused private stakeholders who have volunteered to tackle financial inclusion challenges that they see on a local and on national level. In addition to facilitating dialogue and collaboration, the OCC is contributing expertise on safety and soundness, consumer protection, fair treatment, and fair access questions. Critical to the work and success of Project REACH are the representatives of nationally recognized community and consumer advocates who are intimately familiar with the needs of minority communities. Project members like Operation HOPE and the National Urban League have for decades educated, supported, and guided consumers facing challenges with credit access. And then they guide them through their credit journey. As trusted community advocates, they are essential to identifying fair and appropriate ways to expand access and inclusion, and then to educating the millions of consumers who may benefit by the efforts of Project REACH. These community leaders are working with leaders from across the financial services industries through individual work streams to identify and eliminate obstacles to credit for consumers in order to expand accessible homeownership for minority home buyers who cannot afford high down payment requirements, to enhance minority small business opportunities, to invigorate and reinvigorate minority banks that serve often neglected communities, and to help provide financial access for the credit invisibles who are often unable to secure traditional credit because they don't have credit scores. I'm very active in convening the Project Reach workstream that is looking at whether consumer permissioned alternative data can be identified and fairly used by banks and other traditional lenders to expand financial access. This group is discussing ways to identify, obtain, and analyze alternative consumer data, such as average deposit account balances, cash flow in checking accounts, or timely and regular payments for non-credit bills like rent, cell phones, or utilities that may appear in bank accounts or from other alternative sources that retain that type of data. By working collaboratively, this work stream is building on related efforts that have been undertaken in recent years and moving forward with ideas that we hope will be piloted later this year. As many of you may know, the nation's 3 credit bureaus have typically tracked and used credit repayment performance for a specified number of trade lines over a particular time period in scoring consumer credit worthiness. The traditional approach, unfortunately, has resulted in approximately 45 million consumers being credit invisible. That makes it much more difficult, if not impossible, for them to obtain a mortgage, a credit card, an auto loan, or any other personal type of loan. So who are these credit invisible consumers? Well, they disproportionately are low income and minority consumers who don't use credit or have not used credit on a regular basis. I believe that this can be by choice or by circumstance. And without active credit histories, they don't have traditional credit scores. They may not have credit scores because they manage their financial lives with cash instead of credit, or only use credit infrequently. But many of these people are hardworking, responsible people who regularly pay their bills on time. And when short of cash for groceries or medical expenses, rather than being able to qualify for a bank loan, they may be forced to turn to payday lenders or other non-traditional credit sources and pay very high fees in the process. We believe millions of these credit invisible consumers could benefit from home ownership and other wealth building credit opportunities if their credit worthiness could be assessed by considering their full financial records. And by full financial record, I mean good management of their demand deposit accounts or timely payment of recurring financial obligations like rent, cell phone bills, and utilities that may not appear in their demand deposit accounts, but it's available just through other sources. A majority of consumers, as many as 70%, would permit a lender to obtain such alternative data if it improved their chances of getting loans or lower interest rates on loans, according to an Experian survey. Increasingly, non-bank financial service providers are analyzing alternative credit data in their underwriting. Some are employing a consumer's cash flow data obtained with permission by accessing a consumer's bank account to extend unsecured and relatively short-term credit to consumers and businesses. In the case of small businesses, there is evidence that using data from companies' bank account records, accounting software, and e-commerce platforms and payment processors can be useful in facilitating access to credit for small businesses. An empirical analysis of 6 non-bank credit providers conducted by FinReg Lab a nonprofit think tank, found cash flow data to be predictive of credit risk across providers, products, and borrowers. Other firms are beginning to mine other databases. New products such as FICO Score XD, Experience Boost, and TransUnion eCredible Lift analyze telecommunication, utilities, and public records information. FICO has also developed the Ultra FICO score, which is based on the borrower's record of managing their demand deposit accounts and can be used to supplement the traditional FICO score. Dave Schellenberger of FICO will discuss this product later in the session. Some firms use artificial intelligence or machine learning in the lending process in order to most effectively analyze big data and consider alternative data and analytics related to credit risk. In 2017, for example, the Consumer Financial Protection Bureau issued a no action letter to Upstart Network Incorporated, which uses machine learning in credit decisions. At that time, Upstart used data related to borrowers' education and employment history. As a condition of the no action letter, Upstart agreed to conditions related to consumer protection, risk management, and fair lending impact analysis. Upstart reported that its alternative data model, when compared to a traditional credit model, approved more credit applicants at a lower cost across all consumer segments and showed no disparities that required further fair lending analysis under Upstart's compliance plan. The OCC recognizes that using alternative credit data in underwriting carries risks for banks and consumers. Banks face risks if consumers choose to disclose only positive data, leaving lenders with too rosy a picture of their creditworthiness if, for example, late bill payments are not disclosed. And consumers could be harmed by the use of data that does not have an understandable relationship to creditworthiness, such as data on social media or internet browser activity. Recognizing these types of risks, in December of 2019, the OCC joined the Interagency Statement on the Use of Alternative Data in Credit Underwriting, which highlights risks and benefits to banks and consumers of using alternative data. The statement recognizes that responsible uses of alternative credit data may improve the speed and accuracy of credit underwriting and help credit invisible consumers obtain credit. It references the relevant consumer protection laws and regulations applicable to the use of alternative data in underwriting. And it also stresses the importance of appropriate testing, monitoring, and controls to ensure consumer protection risks are understood and addressed. As the use of alternative data and other innovations evolve, the OCC encourages the banks we supervise to discuss questions and issues regarding new and evolving financial technologies with the examiners assigned to them and the OCC's other experts. To give banks and fintechs a centralized point of contact for discussion of these types of issues, in 2017, the OCC established our Office of Innovation. Since 2018, this office has held meetings that we call office hours in cities across the nation where OCC experts hold one-on-one meetings with banks and fintechs. Now, these office hours and office hours meetings are currently being conducted virtually. And the next session, for those of you who might be interested, will be held on March 17th and March 18th. The Office of Innovation is also working to launch an innovation pilot program to give eligible entities the opportunity to seek the OCC's regulatory input early in the testing of new or innovative activities that may offer opportunities or benefits to consumers, banks, and communities. The OCC is incorporating into the pilot program framework the public feedback we received when we published a draft pilot program for comment. So you see, the OCC sees responsible innovation as an important means of expanding credit and financial access to millions of disadvantaged consumers. But recently, I've been intrigued by another phrase, equitable innovation. And when you put these phrases together, you begin to see the potential for our country. The OCC seeks to ensure that banks and fintechs fully understand the range of potential risks and benefits for safety and soundness, fair access, fair treatment, and compliance. I'm pleased with the OCC's actions, like Project Reach, that are using our agency's resources to support industry efforts to expand financial access and inclusion for millions of disadvantaged consumers. Working together in these types of efforts, we can make our financial system and economy more equitable for all. And we can help to open the door to building generational wealth through homeownership and other credit opportunities that so many of us take for granted. I look forward to sharing more about the accomplishments of Project Reach participants in the coming months. I'd like to thank you again for inviting me to speak with you today, and I look forward to hearing the panel's insights and suggestions on how we can make our financial system and economy work for everyone. Thank you again.
Grovetta, that was absolutely awesome. And those weren't my words. One of the panelists wrote in the one of the participants wrote in the Q&A. That was just an awesome presentation. Thank you so much.
Well, thanks again for letting me.
Let me actually start with one question from me, and then we're going to move immediately to questions from the audience. So can you provide more details about the timeline and possible deliverables for Project Reach's Credit Invisibles work stream? You mentioned that there might be some deliverables as early as later this year.
So, Lori, I'm going to adjust my sound just a little bit. So, I do hope that we'll be able to do something later this year. We spent the beginning, or what I call phase one, of the Credit Invisibles work stream, really gathering information, meeting with a lot of different companies that have had the opportunity to engage in aggregation of data in different ways, bringing together our community advocates, national civil rights organizations, and these lenders. I think now we're moving into phase two, and phase two is where I see actionable progress being made. And what I'm hoping for is that we'll be able to take some of these wonderful ideas that have come from phase one and pilot them in phase two, so we can see if some of these proofs of concept, if you will actually have the positive impact on the lives of millions of credit invisible people who, as I said before, are responsible. They pay and manage their finances every day, every month in a responsible way, which is an indicator of credit worthiness. We need to expand the way we think about it. So I'm hoping that in 2021, I'll be able to come back and share some very positive news with you when we hopefully move into the pilot phase.
Thank you very much. Question from, actually, there are two different questioners in the audience who have basically asked the same question. What about the issues of discrimination that alternative data raises? Is there some way of safeguarding against this? Are there issues of possible structural discrimination that are when one moves to alternative scoring?
So I think we have to be mindful of that. And when I've talked to financial institutions that we supervise, as well as some of the entities, who are lenders or fintechs and other parts of the financial industry, one thing that I oftentimes tell them is that when you're making credit decisions and you're looking at alternative data, you need to be sure that what you're looking at are indicators of risk and not indicators of race. And I think that raising that consciousness and awareness looking at things that could be problematic for consumers from a racial inequity perspective. I mentioned earlier looking at social media or browser history. Things of that nature may not necessarily give you indicators of risk from a financial standpoint, but they may be indicators of race and then be used in a very negative way. So we have to think about that. And through that, that's education. That's our ability at the OCC to help lenders understand. The ones that we supervise are folks who come through the door for office hours with the Office of Innovation. The responsibility to comply with all consumer laws does not stop at the doorstep, and you cannot ignore prohibited basis such as race when making those types of decisions. So you can use old data in a new way, but it still has to comply with the law.
Thank you very much. There's actually quite a bit of interest in finding out more about Project Reach. One participant asked, is there a report on the work that's already been completed to date and what you're going to do going forward? What resources are available to consumers? And another person asked, is there a way we can get involved?
Absolutely. So I would tell everyone to go to the OCC's website, occ.gov, and you will find there a link to Project Reach. We have an entire page that actually details all 4 of the work streams that I mentioned in my remarks. And our national coordinator, Andrew Moss, I think, is tagged in that on that homepage. I would encourage folks to reach out to him, and then we can get direction to any of the work streams. There is a lot of work to be done. And so I think if people are interested in becoming involved, please contact our agency. I'd love to have more help.
And one final question, will any of Project Reach be applicable to those who are undocumented and don't have social security numbers, for example?
So we're not trying to solve everything with Project Reach. I would not sit here and tell you that I believe that some of the credit invisibles that are in that 45 million or so may actually include undocumented folks here in the country. But our goal is to see how we can develop an alternative way of looking and scoring their credit worthiness. So one step at a time in trying to help millions of people in the country who have for decades, if not centuries, been disadvantaged by our financial system. As I said, we have a lot of work to do, but I'm hopeful for our future.
Well, thank you very much. That was just, again, an awesome presentation. Thanks for being with us today. At this point, I'd like to, and there were tons of questions that we didn't get to, but thanks. Thank you all so much. And for those of you who I didn't have time, my apologies on your questions. With that, I'd like to introduce our really great group of panelists. We have Sean Reif, the Director of Credit Scoring at Experian, David Schellenberger, Vice President, Scores and Predictive Analytics at FICO, Michelle Singletary, National Syndicated Personal Finance columnist from the Washington Post, and Kelly Thompson Corcoran, the Deputy Director at FinReg Lab. So actually, why don't we start with Michelle? What was your biggest takeaway from Grovetta's comments? Michelle, you're muted.
Yep, I didn't follow all directions. So there was just so much that I thought she talked about. There was 2 areas that I made note of that I think was so important to this discussion. She said that as we look at alternatives, be sure that we don't confuse risk with race. And then secondly, those who choose to have credit, to access credit, or they can't access credit because of their circumstances. And I thought those 2 bookends is really apropos for our discussion. And, I have to tell you, my background is, what I do for a living, but I come from a low income family, but also a family of homeowners and landowners. So we've always known the value of having home ownership. I have been a homeowner since about a year out of college. And through that home ownership, I was able to help take care of my disabled brother. And so I think we have to talk about it in that sense of, it's not just a matter of lifting up an individual when they have access to credit, but the legacy that they create for their families. Because my brother, who was disabled, had a place to live. He didn't have to worry so much about bringing income for himself because I was helping take care of that. And then lastly, and I'll let you go to the other panel, this whole idea of risk and race. We need to be very clear how racism is baked into a lot of financial things that we do. And I just read a brief by the National Consumer Law Center, which was just brilliant, talking about the pandemic and the credible invisibles, and just how, in a way, the fact that they don't have credit is actually helping them because they aren't defaulting on credit card debt and so forth. And I think that was their paper to talk about that. And we have to be very careful as we go forward because when we, for example, add in rent, well, lots of low-income people are in places where the apartments are not affordable, and so they move a lot, and they have trouble paying it, not because they're not responsible, because the housing is so already expensive, and they're not making a living wage. So if we're gonna add that data, we have to, and I'll end on this one word, put everything in context. You can't just look at the raw numbers because we sort of think that numbers are race neutral and they are not.
Thank you, Sean.
Yeah, Lori, thank you so much. Absolutely a pleasure to be here. This is such a great platform. I'm going to double down on what Michelle talked about in terms of the idea of risk versus race. And I'm going to throw another element in there, and that's with regards to psychology too, because there are psychological barriers as well, Lori. Here's kind of my take on this. I've had the honor to be part of Gravetta's leadership with regards to Project Reach, and I've been tasked with driving alternative consumer permission banking data into the credit space to maximize outcomes for communities of color. So what I take away from this is that opening a new path to credit inclusion as a metaphor for wealth building is really the idea behind Gravetta's vision, right? If we can harness the power of consumer permission data, and this is key, to help lenders make approvals that they otherwise couldn't or wouldn't, that is the first of many steps that we're going to have to get over. So Gravetta and Michelle are absolutely dead on when they talk about that. And it was interesting hearing some of the comments too, that we're talking about the idea, of obviously risk versus race. How can we ensure that consumer permission data doesn't do anything in the way of actually preventing first and second chances? Well, to me, I think that there are historical, financial, and more importantly, psychological barriers to this that we have to get an understanding of as it pertains to financial attainment, if you will. Consumer permission data directly helps to straighten and provide a runway, if not level the playing field, to help credit invisibles who were so disproportionately minorities and coming from the underserved communities, right? So I've had the honor of running credit risk at Experian for a number of years now. And so I've spoken with regulators, lenders, and the consumers themselves. And from my vantage point, it's really this idea of the psychological barriers behind really race and risk that is so important, that is actively being addressed by consumer permission data. So let me talk about it like this. If the underserved can see that we're actually empowering them to take charge of their credit, like we do with things like Experian Boost, which we'll talk about later, which is the embodiment of driving consumer permission data to become part of the credit process, not to be afraid of it, not to have been victimized like we so often have in the past, with data they actually already have that quantifies their credit character. We've actually tackled the curse of psychological expectations, and we've actively gotten into the idea of looking at a person's risk profile, their credit character, if you will, versus their race. Now, the fact that the data itself quantitatively raises the credit score. The exact data that Gravette is talking about, this consumer permission data, actively in almost all cases raises a credit score, further cements that use case. So I love the question, and I love the way that Gravette articulated it. And Michelle, thank you for laying the groundwork for letting me answer that question.
Yeah.
Well, thank you both. With that, I'd like to move to Kelly. I think Sean said something which I thought was very good. Was sort of summarized it, is that alternative credit allows lenders to make approvals that they otherwise couldn't or wouldn't. What types of consumer permission data are available? What are the advantages of them being consumer permissioned, and which do you think have the most potential? I know you've done a lot of research on this, and looking forward to hearing your answer.
Sure. Well, thank you so much for the invitation to participate today. It's a joy to be here. So I think it might be helpful to talk about two terms. We've talked about alternative data and customer permission data. Those terms overlap, but they're not exactly the same concept. So that might be helpful to start. Traditional credit report data tends to be largely about credit payment history, some information about other debts, particularly ones that are substantially overdue, and then some public record history. Alternative data can refer to a huge range of things that aren't traditionally in credit reports, but may be useful for credit scoring and underwriting. So it can be financial in nature, as we've already been talking about, things like other kinds of payment history or information about income and assets. Or it can be farther afield, non-financial, things like digital footprint use and some of the things that Gravetta mentioned. Customer permission data is really about the process by which the data gets into the system. What it is, the data itself can be different things at different times. Where we're seeing customer permission data used most primarily is with transaction account data, so bank account data, prepaid account data, and for small businesses, some other kind of forms of information about their cash flows. And also some payment history, particularly with regard to telecom and utility. And what's different about this data is it's not being furnished by companies kind of into the traditional credit reporting system on an ongoing basis. Rather, it's the initiation of the transfer comes when the customer is applying for credit and is interested in reaching out, and it starts with the customer's permission for that process. It usually runs on a different set of pipes as well. It involves a different set of intermediaries called aggregators. And there are times where credit bureaus and scoring companies are involved too, because they're seeing some of the value of this data. But there's some differences about the process by which it's being moved around the system. Generally speaking, it's not being put into the general credit reports that everyone thinks about. It's being held somewhat separately because of that permissioning process and so on. So there's some overlaps between all these categories. There are a lot of advantages to customer permission data, both I think because of the nature of the data and because of the processes. On the nature of the data side, bank account information in particular and cash flow information, which is what our research focused on, can be particularly useful because it's up to the minute and it shows you not just how consumers or small businesses repay certain forms of credit, the kinds of things that show up in their traditional reports, but it also tells you things about income, it tells you things about savings, and it tells you things about a broader range of recurring expenses. So other types of bills and so on. The other reason why customer permission data in terms of its nature is particularly appealing is because it's maybe substantially more widely available than traditional credit report data. So about 20% of US adults can't be scored under some traditional models because there's not enough information in traditional credit reports to run those models. But we know that about 96% of US households in 2019 had either a bank or a prepaid account. And some surveys suggest that up to about 91% of US adults have at least one telecom or utility account in their name. So there's a chance to reach and understand what's happening with the finances for some of those people who can't really be seen very well in the system, as well as people who can be seen in the system. But having a more fulsome picture might help lenders differentiate risks and be able to lend more deeply to more people. On the process side, there are two advantages. One is that the consumer gets the infrastructure that's being built for this information allows the consumer to decide if they want positive payments history to be considered, even in circumstances where the companies that they're working with aren't reporting it into the general system on their own. And the other thing, as we've already talked about, is the fact that the customer makes the decision about when they want the data to be used and for what purposes. So those advantages are attracting a lot of interest from a lot of stakeholders right now. At the same time, realizing those advantages in practice really depends on a lot of nitty-gritty detail about how the permissioning process works, how the data is being used in individual models, and so on. So there are a lot of things that are still getting sorted out, but it's an extremely promising category because of both the utility of the data and the potential control that the consumer has over how the information is being used.
Great. Well, thank you very much for sort of making all those distinctions clear. That was extremely helpful. Dave, has technology and other innovations expanded access to credit in the past few years? That is, has it allowed more people to be included in the credit system? And if so, how?
Yeah, I think it has. And I can share a little bit about our journey at FICO. We actually created a financial inclusion initiative several years ago. And it started actually not so much with consumer permission data, but looking at some of these other types of alternative data sets that would be considered at rest or in repose, and governed by the same sort of FCRA regulations as traditional credit bureau data. And this entails data that repositories that consist of telco and utility payment type information. It consists of other types of public record type information. And our focus really was on the unscorable population. So that roughly 40 million to 50 million consumers that have that are not scorable. And we've seen good traction with that. I mean, we've scored out millions of consumers and helped them obtain their first credit. Now, typically you won't use a score like that for mortgage underwriting purposes, as people typically don't go out and get a mortgage as their first credit obligation. But we've helped them get an on-ramp into credit using that type of data. Now, consumer permission data, for all the reasons I think Kelly kind of called out, is very intriguing. And there's a lot of interest in that. We work very closely with our partners at Experian and Finicity, who is a data aggregator, to leverage that type of data. And the approach that we took was that we would take whatever credit bureau information is available, and this came from Experian essentially, and augmenting that with consumer permission data. And that data consists of demand deposit account information, checking, savings, money market account information. And what we saw was that we were able to get a significant gain in terms of the predictive power of the models, particularly amongst those consumers that had very thin files, perhaps like 3 trade lines or less, or consumers that had previous derogatory information. So they may have stumbled, they may have had difficulty paying their bills in the past, but they regained their footing. You can't really see that using traditional credit bureau information, but using checking and savings account information, you can start seeing cash flowing coming back in, and that information can be used to get these consumers back into mainstream banking. Now, I think there's a lot of interest in that. Our personal journey got disrupted a little bit. We were just about ready to make strong headway. Sean's nodding here, and the pandemic hit, which challenged us. I think though we're starting to regain our footing, we're having more conversations about this, again, for all the reasons I think Kelly called out. And I think that there's a pretty strong shift towards moving in this direction. There are a number of challenges, I would say, but I think we're making measured and persistent progress on this one.
Thanks. Does anyone want to follow up to Dave's answer?
I'll
Kelly?
just say one quick thing. So we published our main report on cash flow data in a series of reports in 2019 and 2020. So that looked at questions about the predictiveness, the inclusion effects, and fair lending effects, and really evaluating those questions. Last fall, we also published an update, a research brief, just cataloging all of the things that are kind of going on in the market right now. We've really seen a lot of initiatives involving customer permission data in these kind of two types of data that I was talking about start to hit the market. So there's a lot more options out there for lenders who want some help in getting to the data and figuring out what's predictive and what's potentially useful to them. I think there are two questions that are still out there. One is lender uptake. Where and how and when did they really dig into this and start using it more broadly? And the second question is consumer uptake. Because this is sharing more information, and the rules and protections that apply are important to think through. And there are some regulatory questions in that space that are still getting sorted out. So we've seen the pandemic affect in two ways. I mean, one, it's affected lenders because they're thinking about their own business models and how they're managing risk in the short term. We saw a lot of lenders maybe pull back in early months of the pandemic as they were kind of getting their own footing. At the same time, I think the racial justice protests of the last year and the fact that the pandemic disruption to the economy is so severe really creates strong incentives to dig deeper and think more deeply about what information we use, what models we use, how do we evaluate risk going forward. So there's a real opportunity here, but I think this coming year will be, we'll really start to see how deeply that goes and kind of how much it takes off. The pandemic has done so much economic damage. There's a real need to, dig deeper on this as well. So there are a lot of things in motion at the same time.
Thank you. How can we, this is a question for Sean, how can we ensure the information being used is accurate as we incorporate more data sources?
Great question. So to me, I guess I'll take a step back and I'll say that to the extent that financial inclusion is really here at the Bureau job number one, data accuracy is really mission critical to that entire ideal. Okay, so Experian's commitment to both of these ideals has led to a 99.9% accuracy rate. So that's amongst the highest in the industry, and certainly the entry point to our 100% accuracy goal. What I would say is, in terms of ensuring data accuracy, it's all about employing what I kind of call the three basic lines of defense. Okay, so the first line of defense is specifically, what can our data furnishers do? To that end, we ensure that they follow very stringent, standardized Metro 2 standards pertaining to the reporting of the data, the vetting of the data, and ultimately the auditing of the data into perpetuity. So that's first and foremost. Second, there's a responsibility by we at the Bureau. So each of the three bureaus themselves, likewise, vetting, auditing, and looking at our records as kind of an internal cornerstone. And then we also sync with regulators, including people on the Hill. And the third rail, and this is where I think it gets really interesting and really dovetails with what we're talking about today, is the idea of consumer transparency and empowerment, Lori. The idea here is that in the 70s, the FCRA set clear and very laudable guidelines for data accuracy, ensuring that all data that's used in credit decisions are disputable by the consumer, displayable to him or her, and in the case that there's something wrong, correctable by we, the bureaus. So notably, this is where Experian Boost comes in as kind of a boon to that data accuracy. So Boost, for those of you who may not be fully aware, is a 100% free service that empowers consumers to take charge of their credit by actively volunteering additional information. Things like their utility bills, things they already have that speaks to their credit character, Netflix, Disney, Hulu bills, used in their credit score calculations. So we can work with Dave's group at FICO to actually augment the score to literally boost that score. That's the idea behind it. And so we've seen that of itself drive data accuracy, as millions of those consumers who provide consumer permission data now have yet another avenue that they did not have prior to the addition of consumer permission data to dispute inaccuracies, as well as augment that all important data quality. So I would say that the net effect of those three layers of defense, right? What we're doing on the outside, what we do as a bureau, and in terms of empowering that consumer transparency is all about maximizing data accuracy of itself. And I really think that financial inclusion of the type that we're talking about today is a springboard to that exact idea. And it's very much in concert with our goal of maximizing inclusion because it creates a benchmark as well as kind of a target for the future in terms of leveraging, auditioning, and ensuring key colorblind information is leveraged in a way that is going to maximize opportunities. And as we move forward in the future, where we're doubling down on this idea of consumer permission data, we're going to continue to do that, right? We're already looking at additional assets, things like, again, consumer permissioned verification of income and employment data, all of which speak to the credit character, all of which the consumer, him or herself, can actively provide to augment their credit score. And in terms of the overall big picture, make sure that we maximize the overall data accuracy itself.
Can I jump in here really quick? Do you mind?
Please.
There are a couple of things just on that last part about income and employment. Again, I hope everybody writes down this word context, because if you're going to start including income and employment, recognize that minorities and people who may not have credit files tend to have less income. If you're going to be comparing them to a wider group, you've got to make sure you put that in context of where they are and the fact that, for example, African Americans still earn less than white males and white females and so forth. And also women tend to earn less. So when you build that black box that's going to put all that stuff in there, it's got to have some context. And then when you talk about accuracy, if I can, I love FICO, I love what, and I work with Experian, I work with all of it. You all know that I try to get the information out there, except you guys still have a long way to go in terms of helping consumers correct incorrect information. I know this from personal experience. I also know this from helping people, because the box that you have now for that, the incorrect information comes in, consumer says this is wrong, and you go back to the person who furnished that information, and then that person says, oh, it's right, because it's coming from them. And so you end up in this sort of, circle of trying to prove the unprovable because they've got the data. So I think even though if you percentage-wise, the industry will say, well, we've got 100 million people and only, 5 million have inaccuracies. Well, that's a whole bunch of people. And those folks who fall into that category may well be these people with these thin files and then fighting it. And this goes back to what you said, Sean, about psychological. I have 2 degrees, so I can be on the phone with you for hours and get what I need. But if you are a working class person and you're trying to take care of children and you got job insecurity, you don't have the time or tenacity or the psychological willpower to fight through getting things correct. And I think we want to make sure that we build into that system when we start including all this data, a way for people to get that information done correctly without doing all these somersaults that you often have to do to correct data.
Yeah, Michelle, I think you nailed it. And if I could just respond here, I actually agree with everything that you're saying. I think to me, sitting in the chair that I do, being a person of color, I'm very much aware of the barriers to entry that there have historically always been. So I've been very big on the idea of access, right? How can we ensure that there is more access in ways that there was not before? And one of the interesting things is that what we find, it's kind of this paradigm to the extent the data is colorblind. And I think you're nailing this, Michelle. All data, to the extent that it does that, provides better outcomes. Our metrics are always about predictive performance, right? Making sure that at the end of the day, the people who come in are going to be good or bad credit risks and being able to price that overall risk relative to the interest rates that he or she should be getting. It's also about expanding opportunities by scoring people who were previously unscorable. And what it also is making sure that there is additional information that can augment what is already out there. And all too often, what we see in the credit decisioning process is that a person's going to look at only their credit trade lines, hard inquiries, and public records, and they're going to get a score. And that score is only going to be a function of what we're seeing in the credit file today. The problem is even if you actually can be approved based off of that. It's going to be that all important step of let me see your past 2 pay stubs, right? And so the idea of verification of income is, even if it is significantly lower, which you're absolutely right, we do see that in our community, at least it's showing a trajectory. Because so much of what happens in credit, so much about the credit decision itself is driven by how long you've had credit. Just like the TV show Mad Money with Jim Cramer, he always says that the best indicator of future results is past performance for stocks. Well, that's how we look at pretty much everything as it comes to credit character. So everything to me, to your point, Michelle, read you loud and clear. It's about promoting access. It's about expanding, and it's about enhancing the viewpoint of consumers we already see, to see another side of them that, again, that the lenders may not necessarily be able to see without it, to make a decision he or she otherwise could not. So I appreciate putting that out there. I'm in 100% agreement.
And actually, is one thing that I'd like to have Dave, I'd like to ask Dave to sort of comment on this as well. And one additional question is, as people sort of permission various types of data, you haven't had the experience to have it sort of wholesale incorporated into your models. How do you deal with that?
Sure. Yeah, it's a good question.
Utility data, and someone else does their cell phone data, and someone else does their rental payments. You don't really have enough of any one to truly calibrate your models. How do you deal with it?
Well, you try to pull whatever. So let me address that piece first. We try to, in certain ways, be opportunistic in terms of the types of data that are available. Right. So from a development standpoint, we need to ensure that we do have enough observations from typically millions of consumers to ensure that whatever patterns that we see, if we can get hold of utility data or property data or cell phone payment, makes sense. Now, in terms of accuracy, it's there. From an analytics standpoint, there's a variety of different ways that we can sort of ensure that the data is somewhat accurate. And part of that, when it comes to consumer permission data, is how you actually develop the types of predictive characteristics. So for example, one of the key things for us is we're looking at behavior. We don't want to focus necessarily on the value of a home or property. That's going to really defeat the purpose, right? But what we want to see to help establish creditworthiness is, has this person been paying their bills in a timely manner over a period of time? And so if we can look at that over a longer period of time, so bill payment over, let's say, 3 months or 6 months, as opposed to, did you just pay last month's bill? That makes it a little bit more difficult for there to be aberrations. From a lender perspective, it also makes it a little bit more difficult for someone to try to fudge the numbers, right? So we try to keep it as accurate as possible. And part of that has to do with the engineering of how you're sort of taking in this type of alternative data. So I would say hopefully that helps answer that. But just to respond to a question Michelle made, absolutely you have to look at data in context. One of the ways that we address it in the modeling perspective is we'll build submodels. So we'll build models, for example, for people that are relatively new to credit. It doesn't make sense to assess someone's creditworthiness for someone that may have only had credit established for a year or two the same way that you would assess someone that's had credit for 20 years. And there's a variety of different ways to do that. But I think that's extremely important to understand context, both from an analytic perspective, but also in a much broader perspective, I think, has been discussed here.
David, can I ask you a quick question? How much more work are you all doing to open up that black box to really explain to consumers how to get a better score? One of the biggest complaints I get from people is they pay off their mortgage, for example, and their score drops. I've been calling you guys forever to explain to me why that happens. And you do explain it, but to an everyday person, it doesn't quite make sense. And also, you know, there's all these different types of scores. And I know, Laura, you might get to this question later.
That's actually your next question. So you
This idea that there's like consumers.
how did the version control the many versions and, you know, how consumers may be seeing different numbers than end users. So why don't you actually talk about that? And then Dave can kind of answer both. Maybe that's the best way.
Happy to. Go ahead, Michelle, and I'll
So
later
I
on.
think what I like about what I do is that, first of all, I report about this stuff, but also I run a ministry at my church with 100 or 200 people every year go through it for an entire year. So I get to see people's real budgets for a year. I get to see their credit scores, how they go up or down for a year. So I get to see how these things actually work in practice. And so what is very confusing to them is all the different types of scores. And perhaps this is more of a conversation for those on the call or on this webinar who are in the policymaking business, so we've got the consumer score, we've got a score that the insurance companies use, that the car lenders use, that the mortgage lenders use. And if we're giving consumers scores that are not exactly closely tracking with the lenders, that gives them sort of sometimes false hope of where they are. And the more accurate data that they have to the actual score that is being used, the better their practice is in how they handle their credit. Because if a consumer score says you've got, 700, but the lender's mortgage score says, really, no, it's really more like 650. That's a huge difference. It might not be that big, but there's a huge difference in terms of where you are placed in that tier. And it makes it harder for me, who's trying to get them to do more, because they feel like, well, my score is great. And so we just want to talk more about, at some point, and maybe OCC and other regulations get in, but we've got to have some consistency in the scores that people get so that they can accurately do the things that they need to have a better credit profile.
So I think that makes a lot of sense. And I think one of the key things I think is around education. It's funny, I've been with FICO for over 20 years. And when I started, we were this back office sort of function, and nobody even knew what a credit score was back in the mid 90s. And I think we've been making a lot of progress in that. We're working to broaden education through a variety of programs. One that my colleague, Joanne Gaskin, helps lead is the Score a Better Future type program, which is focused on broadening consumer education with respect to credit and credit scoring. Another important program that we launched was something called Open Access, which is providing scores to hundreds of millions of consumers on bank statements at no cost. And I get that from my bank. So it allows consumers to get a better picture on their credit and to start to learn on that. Now, one of the challenges also that we've heard is, and I hear you loud and clear, it's consumers should get access to the score that the lender is actually using for their decision-making process. And I think that's critical. We've worked hard to ensure that we make our scores available to consumers. And that way, if you're part of the open access program, you are getting the score that's being used. And it's just critical to ensure that the consumers getting access to the score that the lender's actually using. And we've had good success in that, I would say.
Do you mind if I jump in for just a second? I think one thing to think about here is, as we are starting to talk about new forms of data, there's another consumer education challenge, right? Because consumers, I think, over time have learned something about traditional models and traditional reports. But now if we're considering things like checking or prepaid account data, that's a new source of information, and there is some educational burden that comes along with that. It's important both for lenders to be clear going in, kind of what information they're planning to use, so the consumer's permission is really meaningful and robust. And also on the back end, when lenders make adverse decisions or charge higher prices because of a consumer's risk profile, to be really clear about what factors are playing in. I think one of the things that's helpful about cash flow information is because it's pretty intuitive. It's kind of balancing checkbooks, right? Thinking about income and outflows. Are you able to save and those kinds of things? So it's not incredibly hard to explain, but it's important to be transparent and to help consumers understand so that they can both make meaningful decisions when they authorize this data to flow, and they can improve their chances of approval over time. So I think there's some new wrinkles on this question coming up as data sources kind of diversify here.
Kelly, how would you think that they would use when you talk about cash flow? So if you are living on the edge, your cash, like I keep a ton of money in my account because I'm a paranoid person. So, but a lot of people can't do that, right? And so if you're looking at cash flow, especially when it comes to race, the decision of how much extra or how close are people using their cash has to take in, again, context of the population that you're doing this on. And so my concern, and I think, like I told you, the brief that I read from the National Consumer Law Center, is that the metrics that they use may not necessarily take into account that average person may not have, an extra $100 in their account, or they, may be paying bills past the date that they have to pay it, but they still pay it. So I'm wondering how are we going to work on that?
So different lenders and score and model developers are using this different ways. And, I'm sure Dave and Sean could speak to this too. Some people look at things like income and outflows. So just a general sense of how variable maybe is the consumer's kind of financial situation. Some look at balances. I think a lot of times they will look at negative balance events. If the account is going negative, that's probably a sign that the consumer may have some more credit risk. So it really depends on the individual company as to what types of metrics they're looking at. They're not necessarily looking for huge cash balances. And, a lot of times if people have savings, it may not all be in one account. And so obviously they have to account for those kinds of questions. I think there's no question that when you're looking at financial data, whatever type of financial data you're looking at, disparities in income and disparities in assets can make a difference in kind of families' financial situation, their stability, and their credit risk. And so that is a broader question. Solving some of these information barriers will help lenders do a better job of assessing who can afford to pay and who can't. But we really have to talk separately about how do we get at those underlying disparities, because the credit system can't fully account for those. It can certainly help people build assets over time when they're stable enough to be able to afford credit. But there's some deeper disparities there that go beyond the system, and I think are going to take broader answers to fully work through.
Let me follow up on that. What if, is there anyone who's using the bank data to assess, have you made on-time rental payments? You've managed, you may not make a lot of money, but you've paid your rent on time for the last 2 years. Is there anyone out there who's taking that into account? Or
I'm not 100% sure. That's a good question. There are definitely situations, I think Sean can speak to this, where bank account data or transaction account data is being looked at to identify recurring expenses, particularly on kind of more of the telecom and utility side. I'm not sure if there are particular lenders who are looking specifically only at rent, separate from some of those other categories.
Yeah.
But it is a way that you can do that. You can identify recurring expenses. Now, it doesn't tell you everything that a credit report would, because it will tell you how much the consumer paid. It doesn't tell you necessarily how much the consumer owed. So it gives you line of sight, but there are ways in which both sets of information can be helpful. And our research, for instance, found that where both sorts of information is available, it can shed slightly different light on the consumer's finances and both add insights. So it's possible to do that, but I don't know of a specific lender that's only looking at rent. Sean, do you know? I mean, you all are looking at it in terms of telecom and various other categories.
Absolutely. Yeah, Kelly, thanks for setting that stage. So the short answer is I'm completely unaware of any instance where negative rental data is the sole determinant. Now, having said that, I do
no,
want to...
I was actually asking about positive rental data.
Okay, so that's totally different. And so this is something that I think is a very interesting and important nuance. And it's the idea that at the end of the day, we are truly trying to get approvals when there is oftentimes other information that would speak against it. So making an approval when you otherwise wouldn't or couldn't. I truly mean that. And so what we see here in most of our credit scores is we do leverage some scores. FICO 10, FICO 9 are perfect examples of this, where we can leverage positive, only positive rental information. And so then that brings up two natural questions, right? Does the person who does not have any rental data suffer in a paradigm like that? And the short answer is no. This is like extra credit on a quiz. It can only help you. It can only help be more inclusive in that particular way. What I'll also talk about is David brought up, and we were talking about the idea of ultra FICO, right? Where on some level, consumer permission data, as well as positive, again, only positive, rental information can technically be leveraged in this case to provide an outcome that would have necessarily been impossible before. So if you think about ultra FICO, what we're doing is we're leveraging cash flow information and positive information that otherwise might not be a part of the score to actually, in this case, get a person above a certain threshold that makes sure that he or she is now approvable, or actually puts them in a position to get a better interest rate, both of which are within the best, interest of the actual consumer, him or herself. And I think in terms of how this has been leveraged and the areas we've been leveraging this theoretically is a big boon to credit invisibles as well as other more underserved communities. So I think it is very legitimate to talk about the totality of data and how it can provide negative outcomes. But in a situation like this, where we're using decisioning and positive rental data, it's only being used in a situation today where we're coming up with better outcomes for the consumer than we otherwise could have.
Thank you. I'd like to actually move to the last two questions quickly and then to audience Q&A. Dave, what do you see as the challenges to implementing alternative data, especially for mortgage lending?
So what's interesting, I actually started my career in mortgage, and what's interesting is that actually mortgage is well suited for taking in some of this consumer permission data. If you look today, well, actually they've been doing it for some time through their verification reports. So some data aggregators such as Finicity and others have been providing verification of asset and verification of income reports through programs such as Day One Certainty to help streamline that process. So I think there's an interesting opportunity to pull it in. I think mortgage underwriting is very flexible to a certain extent to accommodate different types of alternative data. So for mortgage, I think they're in a unique position, I think, to leverage some of this type of data.
Kelly, how can we get these important new tools adopted and used? That is, what do we need from regulators? What do we need from Congress? And what do we need from the industry?
Sure. So our report in February of last year, it's been almost exactly a year, really focused on this question and outlined a number of steps that both industry, regulators, and Congress could potentially take to kind of expand the use of cash flow data in a way that is safe and inclusive. And I won't try and go through all of it. I think there's a couple of highlights to pull out. I mean, one is that it takes everybody. This is not a situation, I mean, while this looks really promising, it is not easy to do. It is not simply a question of validating the data, thinking through issues about how it impacts individual populations, making sure it's reliable and accurate on all the things we've talked about. That's all incredibly important, and yet it's only the first step, because it also depends on things like what lenders think about their business models, the segments they're trying to serve, their willingness to invest in changes. In the mortgage market, for instance, it's not just about lenders, but it's also about secondary market actors and what kind of metrics they want to use to evaluate across portfolios. So we're going to need all of the pieces of the system working together to really make bigger, more rapid, more inclusive changes. And as I kind of mentioned in the beginning, I think the pandemic and the events of the last year have only underscored how urgent it is to really dig into these questions. We're not going to be able to solve all of the income and asset issues like we talked about, but there are ways that we could really potentially make a difference here in terms of some of the information barriers that are affecting people. And it's not just people who are unscorable using some of the traditional models. We've talked a lot about them, but there are about 80 million people before the pandemic who had non-prime credit scores. Many of them actually may repay their loans, but the scoring models by themselves can't differentiate within the bands as to who's high risk and who's low risk. So we need other types of information to be able to do that and to give lenders more confidence about being able to lend to populations that are more risky or more difficult to evaluate. So we're talking large numbers, and again, the pandemic is only potentially going to, increase the number of populations there. So we've got to see work from industry. We've got to see work from regulators as well. One set of questions has to do with the underlying data flows. As we talked about, these flows with customer permission data involve a set of intermediaries called data aggregators. There are a bunch of questions about how data aggregators may or may not be subject to various existing federal consumer financial laws. So some of the accuracy protections under the Fair Credit Reporting Act, how may they apply to aggregators? There's arguments about that on both sides. The Consumer Financial Protection Bureau is starting to look at those questions and digging in, but there's a lot of work to do in that space. And I think in mortgage, FHFA is particularly an important player here. We've seen the role that they play even in helping the system move to more modern traditional scoring models. In the secondary market, there's a lot of reliance on models that go back to the 1990s, even though we've seen generations of new models develop since then with more predictiveness. They've been fine-tuned to account for different issues. And those models aren't actually being used in that context yet for some purposes because there's kind of a vetting process that's still going on. And FHFA can also help with other types of pilots and research so that we can really understand what works in the mortgage market and potentially get people more comfortable. And then lastly, there are some pieces that probably only Congress can fix. There are places where there are kind of gaps in the laws or things that really haven't been addressed yet, and it's potential for Congress to need to step in. There's also a bigger question about data security and insurance, and how do we get to a point where the entire system is set up to handle kind of data security issues and potential breaches, and that's potentially a place where Congress can be important too. So like I said, it's going to take everyone working together here. And I think as we come out of the pandemic, really being thoughtful about the decisions that people make. It's not just how do you evaluate applicants, it's how do you report on your existing customers and how does that potentially affect their ability to access credit? How do you work with them in the account process for bank, and prepaid accounts? So there's so many pieces to this puzzle. And so we have a long ways to go, but as we said, there's a lot of reasons to see the momentum as building, I think, from the 2018 event, thinking about how things have changed over the last 2 years. So.
Well, thank you. Thanks very much. That was great. And thanks very much for bringing up the 2018 event. And just FYI, we got a couple questions. There will be a recording of this on our website. You can watch the webinar as if it were live. Let me move to audience Q&A because we've just got a ton of really good questions. The first question is, do consumers get a sense of how the additional data could affect the score before giving permission? That is, how do they even know about it? If you want to overcome psychological hesitancy, examples of how the additional data would change the creditworthiness assessment seems helpful. I don't know who wants to take that question. These are all just jump balls.
I could start. I think with respect to ultra FICO, I think we're moving in that direction. Currently, a consumer can go to a site such as MyFICO or Experian site, for example, to access their credit scores. And we're moving in that direction to provide greater transparency with respect to consumer permission data to answer that type of question. Because I think it's important. And I think I like Sean's comment, it's extra credit. It can help. It doesn't necessarily need to hurt. What's interesting, we actually have done analytics, just to kind of jump on that comment, because many risk managers will say, well, wait a minute, are you just completely diluting the power of any credit score by only sharing the positive information? Because if I'm a risk manager, I want to see both the positive and negative. But we've actually done studies that show that if we're just enhancing a score, credit score, with the positive information, it doesn't necessarily diminish the power of the score. In fact, it will enhance the overall power of the score versus a score that is only looking at traditional credit bureau information. So it's really a win-win, I think, both for the consumers to showcase their positive information, as well as for lenders to be able to get that additional insight that can help them say yes as opposed to no.
Does anyone have anything they want to add? Do you have any insights on the progress of cash flow underwriting? It seems to hold so much progress, but it seems to hold so much promise, but how much is it actually being used in the real world?
It's hard to tell. I mean, we've been trying to get good numbers and we haven't been able to find them. I'd be curious to hear what everybody else hears. We know there's a lot of interest. We know that there are a lot of pilots that have started in the last year. I think, like I said, the events of the last year have really increased interest in this area. But in terms of widespread use, it's very hard to get numbers on it. And at this point, we can't find any. But I'd be curious if Dave or Sean have insights on kind of how to get at measuring those questions over time.
The one thing I would say, I'm sorry, David, go ahead.
No. I would just say, just in response to Kelly's comment, I think it is difficult to get the full span of insight into that. Obviously, it's used quite a bit in small business lending for small, medium enterprise, right? And there's a lot of similar sort of data aggregation technologies that support that type of cash flow underwriting. I think the promise is to bring that into the consumer lending space. I think we'll get there. And I think there are some banks that are doing that, especially large lenders that have their own deposit base. They're able to do that type of cash flow lending, but to look at off us data, data that is specific to a consumer, I think we're getting there in a more broad way.
I was just going to add, I think that we have to also be very careful about how far back and what the periods of that data, because just from my experience, consumers will clean things up and really they've got a history of bad behavior. They know how to clean it up to get that mortgage. And as soon as they get that mortgage or that car, they go back to their bad habits. So we just need to be careful about when we include this data, putting it again in context. You know, that's my favorite word. And then David, I think, is it FICO 10 or 11 where you sort of look at, I thought the last iteration of the FICO where you kind of look at the patterns of when people have job losses and how they handle their money. And I think that's sort of the way to go. To just make sure that we don't introduce some sort of consumer bias, because we've been talking all of today about making sure people have access to credit, and I'm all for that, absolutely. I got a perfect 850 credit score on several models. However, having an 850 credit score does not necessarily mean that I should have credit. You can manage it and pay your bills on time enough that it still doesn't mean that you are financially stable. And I just, want to make sure we pull back in the consumer education, because I am forever telling people you are not ready to buy a house, even though your credit score says that you are, because I know how you've been handling your money, and you're not ready for that responsibility.
I think that's exactly right. Let's not confuse a credit score with an underwriting decision that's taking in the broader set of not just your willingness to pay, but your ability to pay. Which is critical. And I think, Michelle, what you might have been referring to is FICO 10T, which is our trended data score, which actually does allow us to look at patterns over a longer period of time. And that's exactly right. You want to be able to look at patterns to ensure that there's just not a single very recent event that's skewing your perspective of the credit risk. And that benefits consumers quite a bit as well. If let's say you're looking at cash flow and balances, and someone you'd just taken a vacation, that's not the normal for you typically. So you want to look at that longer period of time.
Let me put two questions together. One person asked, you mentioned how home ownership is a key to wealth building. However, many of the mortgage guidelines do not permit alternative credit options. That is, how do you get mortgage lenders to accept things like Boost or other alternative credit? And then the other question in a similar vein was, if you do alternative credit, it oftentimes requires a manual underwriting. Is there any way around that?
I think that relates to some of the things that I was saying before about the importance of some of the efforts that are underway in terms of the GSEs kind of updating what models are acceptable for use, and thinking through pilots and other programs to make it easier to really evaluate, as I think Dave said early on, cash flow and some of these alternative and consumer permission products aren't necessarily being used heavily in the mortgage space right now. So we kind of are going to have to build that research base, and that's a huge part of kind of getting there to do that process. Because the lenders already use a lot of the rails for verification process, the data flow is not hugely complicated here. It's more getting people comfortable with the use and the predictiveness for a mortgage specifically. And so that's where I think there's some pieces still to be filled in. And the agencies can really help industry potentially get there faster. So.
Anyone else want to add anything there? Another question, how can we ensure that consumers actually understand what data they're consenting to share? Many consents are buried in website terms and conditions, which consumers don't see or review. And should data capture be limited to what's necessary for an analysis and nothing else?
Lori, I can take part of that. Yeah.
Thank you.
Yeah, absolutely. I think education is key, right? I've talked about for the last 45 minutes how unlearning is so important, within our community. And that's true, right? To get past some of those psychological barriers. But there is no substitute whatsoever for actually being educated. And frankly, that's on all of us on this panel. And it's something that I personally own, just internally in terms of, being part of the Bureau. And as I think you'll see, we've launched a fairly large campaign for Experian Boost, the idea being that you hold the power of raising your score within your hands, right? The idea that you can actively leverage information that you probably didn't even realize could be used to raise your scores. Michelle was talking about, things like utilities, Netflix payments, things like that, to be able to augment your score. It's not the old rules where it's this black box of information and we don't necessarily know where this information is coming from, let alone how to dispute it, let alone how old it is. And so I think as we start to move forward, a huge part of this has to be consumer education. And I'm very proud of the direction that we're going. But I'll absolutely submit that there needs to be more, to the extent that the consumers understand that they are the ones in the driver's seat, that they understand that the positive aspects of their credit score is going to drive their overall future success, is a message we've got to do a better job of getting out there.
The effort that the Consumer Financial Protection Bureau is doing right now, looking at some of the questions about the data flows, could potentially implicate this too, and potentially create some standards for how the permissioning process works. So that could be a really important piece here to try to make sure that the process and the practices are a little more standardized. So consumers have to have less to absorb, maybe less variation to absorb, and can really focus on what's important in making the decision about whether it makes sense for them for that particular, context and that use case. So.
And can I just add, I'm actually glad we've had a change in leadership. I'll go there. I'm a columnist. I can. Maybe you all don't want to talk about it, but I think making a stronger Consumer Financial Protection Bureau and emphasizing the consumer part of it and not the industry. No offense to any of those of you in the industry, but we've got to make sure that that agency in particular singular focus is making sure that information is transparent and clear. I know you got to put in all those legal language, but that is going to be critical for this population, because if we get it wrong, we're going to not only lose people who are already not in the system, we're going to lose people who may not come back to the system. And so it is critical. It is absolutely critical that we get this wrong for this vulnerable population who has already been discriminated against, who is already behind financially. And so as we tread into these new territories, it has to be transparency. It has to be consumer protected. It has to be, I've always told the bureaus, you need to have a separate system for complaints alone, because the system wasn't built for the end user of consumers. We know that. So let's build that in there so that if we're going to do this, we do it right.
That was actually a great final statement. Thank you. Thanks to a fabulous panel. Michelle, Kelly, Dave, Sean, you all were fantastic. Thanks to the audience. Thank you for the 96 questions we got in Q&A, which has to be an absolute record. So thank you for staying engaged. And again, a special thanks to the panelists. This will be available online. Thanks so much for being with us today. And again, thank you for the panelists. Thank you very much to Grovetta if she's still on. Take care, everyone, and stay safe.
Thank you.